Yo, what is going on, everybody? Today we need to sit down and have a real talk about something that is quietly turning into a total nightmare. You know that feeling when you are at a wild party and everything seems chill, the drinks are flowing, the music is pounding, and you honestly think it is going to last forever. Well, that is exactly what the private credit market has been feeling like for the last few years. But here is the cold, hard, uncomfortable truth: the vibe has officially shifted, and for the first time in this entire cycle, the money coming out of these private credit vehicles has officially surpassed the money coming in. Oh shit, this is the headline we have been dreading. And this is not just about one bad loan or a single borrower having a rough month. This is about a massive machine that was built on the shaky assumption that the money would just keep raining down forever. But now the flow is flipped, the machine is stalling, and honestly, we are way deeper into stage 2 than most people want to admit. Let me break it down for you. See, private credit was pitched as this magical, stable, low volatility place to park your cash where you get those sweet, sweet yields without the headache of daily market swings. It was all about that reach for yield that never ends. But now that investors are pulling their money out faster than new ones are jumping in, these funds are trapped, they have to find cash, and they have to find it fast. So what do? They can use existing cash, they can stop lending, they can try to borrow more, but the borrowing game has tightened up. And that is where the whole story starts to get real dangerous. Once these funds are forced to sell assets, the game changes entirely. Private credit stops being this safe, stable mark to model fantasy and becomes a real world market on the downside. And let me tell you, those markets are brutal, they have prices, and sometimes those prices are not 98 cents on the dollar, sometimes they are not even 90. We are seeing debt trading at 65 cents on the dollar. Think about that. 65 cents. That is not stable, that is not hold to maturity, that is straight up price discovery. And it is the exact thing the industry has been trying to run away from this entire time. Now, I know a lot of you are sitting there asking what you should actually do with this information, and look, I am not a financial advisor. I am just the guy helping you see the pipes behind the walls, but a lot of people are waking up and realizing their retirement accounts are built on a very narrow set of assets. Some of you are looking at physical gold as a potential shield, and if you are curious about how that works, my friends, over at Augusta Precious Metals have been super helpful in educating folks on the mechanics of gold IRAs. They are all about the education-first approach. So if you want to see if that fits your strategy, hit up their site, but back to the chaos. The biggest update here is that non-traded BDCs gave back about $7 billion in the first quarter while only raising $5 billion. That is $15 billion in redemption requests hitting the fan. And it is forcing these funds to slam the gates shut, limiting withdrawals, and creating a massive bottleneck. The pitch was that these assets were somewhat liquid, but the reality is that the underlying loans simply do not trade. They are private, hence the name. And when inflows are bigger than outflows, everything looks perfect. But when the math flips, the liquidity crisis begins, the problem is no longer just credit quality, it is survival. Because if you are a fund manager and you need liquidity, you do not sell your worst assets. You sell the ones you can actually move, which are usually your best ones, so you end up holding the absolute garbage. And that is how portfolio quality turns to rot. We are seeing trading ramp up, which is ironic because this was supposed to be a buy and hold space. But now the truth is leaking out. When you see a loan bought at 65 cents, it means someone had to sell at that price. And it destroys the myth that these things are worth par. And it is not just random bad luck. Goldman Sachs is reporting rising defaults, and Fitch just hit us with a 6% default rate across the space. That is a record high, my friends. It is not just anecdotes anymore. It is a pattern, and the banks are starting to act like it. HSBC is dragging its feet on a $4 billion effort, and players in Australia are dumping what they call frothy assets. This is the classic credit cycle turn. It starts with hidden stress, moves to forced sales, and ends with a broader contraction that hits the real economy. It is a grinding credit crunch where capital gets expensive and scarce, and we are stuck in the loop. Higher defaults lead to lower valuations. Lower valuations lead to more redemptions, and more redemptions force more sales. It is a downward spiral that is impossible to stop. So when you see the news, do not just look at the headlines, look at the flow. The private credit boom was built on the dream that you never have to face a market price. But the market is coming for that price whether these guys like it or not. And honestly, if the real price is 65 to 95 cents on the dollar, then we are really just getting started with the pain. We are deeper into stage 2, so keep your eyes open, stay liquid, and protect your flank because the world is changing fast and you do not want to be the one holding the bag when the music stops. I have seen this movie before, and the ending is never pretty for the people who thought they were safe in the shadows. These funds have spent years telling everyone that they do not need to mark their books to reality. They call it mark to all, but let us be real, it is mark to myth. And now the myth is colliding with a very harsh, very cold reality. Think about the borrowers. These are mid-market companies that were levered to the hilt when money was cheap. Now that interest rates have stayed higher for longer, those floating rate loans are absolute killers. The cash flow is barely there to cover the interest, and these companies are being kept alive by nothing more than the goodwill of their lenders who are pretending that everything is fine. But the lenders are now the ones feeling the heat. They are the ones getting the redemption requests from institutional investors who have their own liquidity problems. And when those institutional giants need cash, they do not care about the long-term health of the BDC. They want their money out, and they want it now. This forces the fund managers to make decisions they never wanted to make. They start by pulling cash reserves, then they stop making new loans. But eventually, if the redemptions keep coming, they have to sell. And that is when the fire sale happens. It is not a clean process, it is messy, it is desperate, and it destroys the value that was supposed to be stable. I have talked to so many people who thought their private credit investments were the bedrock of their portfolio, thinking that even if the stock market crashed, their private loans would stay flat at par, but that is the danger of the illusion. The illusion is that you can ignore the market, but you can only ignore the market for as long as you have the liquidity to support the fiction. Once that liquidity dries up, the market forces you to play by its rules, and the rules of the market are rarely kind to those who waited too long. This is why I keep saying we are in stage 2. Stage 1 was the boom, the easy money, the growth. Stage 2 is the stress, the realization that the assets were overvalued, and the scramble for liquidity. If you are wondering if this is systemic, look at the banks. The big banks are pulling back because they see the writing on the wall. They are the ones who provide the backstop financing. And when they tighten those lines, the entire house of cards starts to wobble. It is not just about one fund, it is about the entire architecture of private credit. It was built for a world of infinite growth and zero interest rates, but that world is gone. We are in a new era, an era of scarcity, an era of higher costs, and an era of volatility. And if you are not prepared for that, you are going to get crushed. I see people trying to pick up bargains, trying to catch that falling knife, thinking that if they buy at 65 cents, they are getting a steal. But what if that loan is worth 40 cents in 6 months? What if the underlying company completely folds? You are not just buying an asset, you are buying a risk. And right now, the risk is higher than it has ever been. So what is the takeaway here? How do you protect yourself? Well, first of all, stop chasing yield just for the sake of yield. If it looks too good to be true, it probably is. Second, focus on liquidity. You need to know how fast you can get out of your positions if things go south. And third, keep an eye on the macro. The credit cycle is not a secret. It is a clock that ticks for everyone, and it is currently ticking against the private credit market. You have to be ready to pivot. You have to be ready to walk away when the risk is too high. And most importantly, you have to stay informed, because the guys running these funds are not going to tell you that they are in trouble until it is way too late. They are going to keep the lights on and the music playing until the very last second. So you have to be the one to see the exit. You have to be the one to anticipate the turn. This is what I mean when I talk about the pipes behind the walls. You have to understand how the system works so you do not get trapped in it. It is not about being paranoid. It is about being prepared. It is about being the person who sees the storm coming while everyone else is still complaining about a little bit of rain. So we are talking about a systemic shift, a transition from a period of excess to a period of reckoning, and that is exactly what we are seeing right now. The fact that outflows are outpacing inflows is a massive signal. It is a fundamental break in the structure, and it is not going to just fix itself. It is going to continue to play out, and it is going to get worse before it gets better. So stay frosty, stay sharp, and most importantly, stay liquid. Do not let your money be held hostage by a system that is fundamentally broken. You deserve better than that, and you have the power to control your own destiny. Just keep watching, keep learning, and keep your guard up, because this is just the beginning of the story, and the end is still a long way off. We are going to be tracking this every step of the way, because the stakes are too high to look away. And if you think this is just a blip on the radar, you are not paying attention to the real underlying data. The 6% default rate is a warning shot, and if you ignore it, you do so at your own peril. The market is telling you the truth, you just have to be willing to listen. It is not going to be an easy road ahead, but it is a road that we are going to walk together, and that is why I am here. That is why I make these videos, because I want you to be the one who comes out on the other side of this in one piece. So keep your head on a swivel, and let us see where this goes. Peace.